Hi there and welcome to this video. My name's Andy Rowe and I run a website called trendfollower.co.uk. In this video I'm going to talk about buying shares, and this is part of my long-term wealth strategy, otherwise known as building my own hedge fund. So why I'm interested in buying shares? Well, shares represent ownership of businesses, and businesses are where the money's at. And if you think about Apple and if you think about Coca-Cola, these businesses have created lots of money over the years because they have produced products that people want and are happy to pay good money for. So I want to be in the area where the money is, and businesses are where it's at, and profitable businesses pay a dividend because this is profit. Some of the profit businesses will reinvest into their company. That's a sign of a good, healthy company. But some of that profit will also be distributed to the people that own the businesses, the shareholders. So that's called a dividend. So I'm interested in shares particularly that will pay a dividend. But that's not the only way I can make money by buying shares, because if shares of businesses are popular, then the price of those shares can go up. And if I buy a share today for £1 and the business is doing very well, it might be that in a year or two I could sell that share for £2. So I will have made a capital appreciation. I'll have doubled my money when I sell that share for £2. So there are two main ways of making money through shares. One is through getting the dividend, and the other is through an appreciation in the share price. Now, doesn't always happen, of course. Businesses go through hard times and don't make profit, and sometimes then don't pay a dividend. And of course, if that sort of thing's happening and the public's perception of the business is that it's not doing very well, then the price of the shares will go down because people won't want to buy them for £1. They perhaps might only be happy to buy them for 50p. So if I bought my share for £1 and then a year later it's worth 50p, of course my money will have halved in its value. So it can go both ways, as it can with everything that we buy and sell. You know, at the moment houses are very popular, and some people think that houses only go up in value. Well, you know, houses do go down in value as well sometimes. There are housing crashes. You know, everything that we buy can go both up and down in value. Look at the graph here. This is the share price of Coca-Cola over 10 years. Essentially, the share price has doubled from sort of $20 up to $40, but it's been a real up and down journey along the way. So shares can go down as well as go up. But the whole aim of me buying shares is that, generally speaking, shares, like most things, tend to go up in the long term, even though they may have times when they go down in the short term. So if I bought Coca-Cola shares 10 years ago, I would have doubled my money. At the moment, they yield 3%. So the dividend is 3% of the value of the shares. So I don't know if that's representative of the shares of the dividend of Coca-Cola each year over the past 10 years, but certainly earning 3% on my investment at the moment is not bad compared to having the money in a building society, particularly if I can see that as years go by, the value of my investment may well go up. So those are really the reasons for buying shares. And one of the good things about being paid a dividend is that I can use that money to buy more shares. I could, of course, just use it to pay my grocery bill, but as a younger person who perhaps is working, one has the option to not use the dividend payment for income, but rather to use it to buy more shares, so the amount of shares that are generating money will increase as years go by, and this then compounds on itself. So if I'm buying shares with dividend from the shares, I have more shares that then will produce more dividend for me to buy more shares, and so it gets bigger and bigger and bigger and snowballs, and you can see on the graph how that happens. And of course, the earlier that I start doing that, the better, really. This graph shows a person that started 10 years earlier than the other person, and you can see how much more the first person's lump sum came to as the years went by. This person, because they started earlier, paid more over the years, about a third more, but ends up with double the amount of value at the end of it. So one of the lessons to take from this video is start your investing early. Major lesson. The people that understand compound interest will earn it. People that don't understand compound interest will pay it. So which shares should I buy? Very difficult to give any advice about that, because no one knows which companies are going to do better in the future. So for most of us who invest, particularly when we're starting to invest, possibly even all the way through our investing lives, it's possibly better not to try and choose which shares to buy, but essentially buy all of the shares in the market. And we can do that through an exchange traded fund, which buys all of the shares of the market. And so I can buy that exchange traded fund, and by doing so I'll own everything in the market. So I can do that through an ETF, an exchange traded fund, an index ETF that will buy all the shares, say the top 100 shares in the UK, through the FTSE 100 ETF called ISF, or I could buy shares, or I could own all of the 250 largest companies in the UK by buying the MIDD exchange traded fund. So there are numbers of ways that we can buy all of the shares in the market in a low cost way through what's called an exchange traded fund, and that's something that's really worthwhile considering when we're investing. And what I would recommend that you do is to look at information about exchange traded funds, tracker exchange traded funds, or index mirroring exchange traded funds. And companies like iShares and Vanguard, if you go to their websites, you can read more about it and find out more about the exchange traded funds that they offer. But essentially it's a low cost, and we want low cost ways of investing in the financial markets. But of course we don't necessarily just want to invest in the financial markets of the United Kingdom. We perhaps want to consider investing internationally through an international exchange traded fund. Vanguard will do something like this. iShares will do something like this. There are a number of companies that will offer international exchange traded funds, and they're really worth looking at just to get investing in a low cost way. Alternatively, we can invest through an investment trust. Now, an investment trust is a company that owns shares in other companies, and the first one of these to open a long time ago was the Foreign and Colonial Investment Trust, and this was open to give the investor of moderate means access to owning shares in companies which wealthy people were investing in. And you can find out more about investment trusts by looking at the website trustnet.com. And what I would recommend that you do is look under the sector that is global, so that you're looking at investment trusts that invest their money in companies all around the world, so that you're thinking about getting a diversified range of investment, not just investing money in Austria or New Zealand or Australia, but literally having money invested in companies from all around the world. And many investment trusts will allow you to invest a modest amount of money every month, so that it's affordable. And that actually makes things easier for us, because what we don't want to do is to invest a large amount of money, a lump sum of money, at a point in the stock market where it's about to fall down. Looking at that Coca-Cola graph that I was showing you earlier, if I'd put all my money in at the top here and then the share price went down by 50%, I'd have been really gutted. But if I'm putting money in every month, then I'm quite happy for the share price to fall down, because I know that I'm getting more money, more shares for my money every month. And this is what they call pound cost averaging. It means we get more for our money, and it makes it affordable and automatic. Many of the investment trusts and people like iShares and Vanguard, who I mentioned earlier, you can contact them and you can make you can get their documentation and set up an account to invest a modest amount per month. Alternatively, you could do it through a stockbroker. Many stockbrokers now offer an online service where you can set up your own account with them and invest a certain amount of money per month in whatever you choose, and you can just set up a regular direct debit that goes from your account to your stockbroking account. Nice and simple. I would recommend that when you do that, you make sure that the account is an ISA account so that it's tax-free in the future, because if I'm buying these shares now, in decades to come, they could be very valuable. I don't want to be paying tax on the dividends that they're paying, nor on the capital appreciation that they make. So I certainly, when I'm doing these investments, make sure that they are in an ISA, and in those companies, the stockbrokers or the exchange traded fund providers like Vanguard or iShares will help you to set up an ISA with them. Don't forget, you can only set up one ISA per year. Alternatively, you can do it through a SIP, a pension, a little bit more complex, but if you've already got an ISA this year, then consider making your investments through a SIP. Again, the broker will help you do that. You don't really want to be investing this money into accounts that are not tax going to give you a tax-free wrapper, but get some advice about that from a financial advisor, or speak to the companies and make your own decisions. Don't just take my word for it. But certainly when I'm making these investments, I don't want to be paying tax on them in the future. What I started to do years ago when I was investing was to make a monthly investment in an investment trust for myself, and my wife did the same in a different investment trust, that we were spreading our risk, and then each year we would change investment trusts so that we had a range of investment trusts. And of course some investment trusts perform better than others over the years, and there's no way of knowing which ones are going to outperform others as the years go by. So we wanted just to spread our risk and invest in a range of different ones. Shares are where the money is created long term, so I think it makes sense to invest in shares in the long term. It's very difficult to know which shares are going to do well, so I would certainly recommend that you consider investing in an international ETF or in a global investment trust. I would not worry about markets going up and going down. What we're doing here is making a long-term investment. This is investment for years to come. And if I'm investing every month, then in lots of ways I want the markets to go down. So this is helpful psychologically, because it's very easy to take your money out of your investment when you think markets are going to go down, only to find that they go up. So timing your investment is very difficult. But if you're doing a monthly investment, it makes it psychologically much easier. Most people just get held back because it all seems too complicated and difficult, and they worry that they're doing the wrong thing, so they end up doing nothing. I would strongly recommend that you do something and just get started, and just do the minimum amount per month just to get going and see that it feels okay. I also recommend that you get a book, Paul Farrell's The Lazy Person's Guide to Investing. I think this is a brilliant book, very easy to read. It'll give you a lot more information about the ideas that I've introduced you to here. So get that book and get reading that. Don't listen to me and think this is financial advice. I'm just talking about what I do. This is what I do at the moment, it's what I've done in the past, and what I'm going to do in the future. It's just going to help you, I hope, fast track your financial education. It's what I tell my kids to do. I'm not a financial advisor. You're responsible for your financial decisions. This is hopefully just part of your education. So there you go. This is part of a series of videos I'm doing about different ways of investing. So make sure you have a look at the videos that are the successors to this one. So hope you enjoyed that, and I hope it gives you a little bit of flavour of how you can invest. So good luck with all your investing in the future. Thanks for watching.